Hi, everyone. Warren Buffett is sitting on more cash than Apple, Amazon, Google, and Microsoft combined. While you're buying index funds at all-time highs, the world's greatest investor refuses to deploy $348 billion. And the ticker he's been cutting? Apple. The company he once called the best business in the world, he slashed it by 67%. Something's broken. And in the next 6 minutes, I'll show you exactly what billionaires see that you don't. The mathematical impossibility behind today's market, and the one defensive position that could determine whether you survive or get crushed when this reverses. This isn't theory. This is data. Let's go. Buffett has been a net seller for 10 straight quarters. The numbers are staggering. Sold $143 billion in equities in 1 year, purchased only $9 billion, reduced Bank of America by 41%, halted all stock buybacks, first time since 2018. Doubled cash reserves from $167 billion to $348 billion. This man built a fortune buying companies and holding forever. His entire philosophy centers on deploying capital into quality businesses. Yet he's liquidating aggressively. When the investor who preaches be greedy when others are fearful starts hoarding cash at market peaks, you don't ignore it. You decode it. The concentration trap. 7 companies control 34% of the S&P 500. Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and Nvidia. If you own any broad market index fund, 1/3 of your money sits in these 7 names. Not 500 companies. 7. The illusion of diversification is killing portfolios. Since late 2022, these 7 stocks generated over 50% of total index gains. Remove them and the S&P barely moved. Simple math. A 40% correction in this group triggers a 15% automatic decline across the entire index before human emotion takes over, before panic selling accelerates, before retirement accounts crater. Your diversified portfolio, it's concentrated tech speculation with 493 other companies attached. The valuation absurdity. Current market multiples. Tesla, 263 times earnings. Palantir, 700 times earnings. Nvidia, 90 times earnings. S&P 500, 29 times earnings. Historical S&P 500 average, 16 times earnings. Let's make 700 times earnings concrete. For a company to justify that valuation at normal multiples, it needs to multiply profits by 35 times, not grow 35%. Increase by 35 times. Assume zero competition emerges, zero regulatory pressure, zero technological disruption, zero recession. Perfect execution for decades. Still impossible. An MIT study analyzed $30 to $40 billion deployed into AI infrastructure. The result? 95% of companies generated zero return. The market price is perfection. History delivers chaos. The warning indicators. 3 metrics flash identical signals. Buffett Indicator. Market cap to GDP sits at 225%. This level appeared twice before, preceding the 2000 collapse and 2007 crisis. Both produced 50% plus declines. CAPE ratio. Cyclically adjusted PE exceeds 40. Only reached at 3 peaks in history, 1929, 2000, and 2007. Each preceded catastrophic crashes. Market concentration, 34% in 7 stocks, exceeds the Nifty 50 bubble, exceeds 1999. The highest concentration in modern market history. Every alarm screams simultaneously. Most investors hear nothing. The hidden opportunity. While growth stocks trade at nosebleed valuations, quality dividend payers sit at decade-low prices. SCHD, Schwab US Dividend Equity ETF. The contrast is violent. Valuation gap. SCHD portfolio, 17 times earnings. Market average, 29 times earnings. Discount, 41%. Income production, SCHD, 3.8% annual yield. S&P 500, 1.2% annual yield. $100,000 invested generates $3,800 versus $1,200. Quality screen, 100 companies with 10 plus consecutive years of dividend payments. Coca-Cola, Pepsi, Chevron, Pfizer, Cisco, AbbVie. Not startups burning capital. Established cash generators that survived Great Depression, world wars, financial crisis, and every market collapse since. Performance reality. 13 consecutive years of dividend increases. 12.2% annual dividend growth. 56% lower volatility than the market. 2022 drawdown, SCHD minus 15%, S&P 500 minus 25%. That 10-point difference separated investors who held from those who capitulated at the bottom. Over the past decade, SCHD returned 11.6% annually versus the S&P's 13.7%. Underperformed during the greatest tech bubble in history by 2.1% annually. The trade-off? Delivered 85% of returns with one-third the volatility, triple the income, and holdings at 41% discounts. Risk-adjusted returns? Not even close. SCHD dominates. Your defensive blueprint. 3 moves, specific allocations, clear execution. Move 1, core defensive position. Allocate 40% to SCHD for income and downside protection. Implementation? Automate monthly purchases to dollar cost average. Markets rise, participate with 3.8% income buffer. Markets crash, accumulate shares at lower prices while collecting dividends. Conservative portfolios, 40%. Aggressive portfolios, 30%. Move 2, maintain firepower. Hold 15 to 20% in cash or treasury bills yielding 4% plus. Strategic purpose? Buffett hoards $348 billion for deployment during fear. You need identical positioning scale to your capital. Set predetermined buy triggers. 10% decline, 15% decline, 20% decline. Deploy systematically, not emotionally. Move 3, eliminate traps. What to avoid completely. Stocks trading above 100 times earnings. Asymmetric risk favors downside. Multiple overlapping index funds creates false diversification. Pure growth with zero yield. No cushion during corrections. Chasing momentum in concentrated positions. The repeating pattern. Historical precedent is unambiguous. After the dot-com implosion, value outperformed growth for 7 consecutive years. After 2022's correction, dividend payers stabilized while speculation imploded. Mean reversion is not a theory. It's a mathematical certainty over sufficient time horizons. Current setup mirrors every major peak. Extreme valuations, record concentration, institutional distribution, retail euphoria. The sequence repeats because human psychology never evolves. The fork in the road. Your portfolio faces a binary decision. Option A, maintain exposure to 7 stocks trading at valuations that preceded every crash in modern history, hoping this time is different. Option B, shift capital into cash-flowing businesses trading at 41% discounts, collect 3.8% yields, and position for the inevitable reversion. Buffett chose. He's holding record cash levels. Institutional money is rotating defensively. SCHD provides exactly what survival requires. Proven companies, discounted valuations, income generation, and volatility protection. These valuation gaps compress. Markets eventually recognize value. The discount narrows. While the crowd obsesses over which speculative stock might triple, disciplined investors build fortresses of dividend-growing companies trading at decade-low multiples, generating quarterly income, and protecting capital through volatility. Wealth isn't built chasing hype. It's preserved through discipline when others panic. The billionaires position defensively. The data validates the risk. The opportunity sits in front of you. Your allocation determines your outcome. What's your current split? Drop it in the comments. I respond to everyone. If this shifts your perspective on market risk, hit that like button. Subscribe for portfolio strategies that prioritize protection over speculation. This content is for educational purposes only, not financial advice. All investing carries risk. Past performance doesn't guarantee future results. Conduct your own research and consult a qualified financial advisor before making investment decisions. This is Invest ED. Welcome to portfolio construction that survives market extremes. Smash that like button, share this with someone overexposed to risk, and subscribe for insights that matter. Protecting wealth, investing smart, profitable investing.